Hello everyone, thanks for coming. Today, I would like to give some keynote for week 7's lectures, the trading strategies for options and the price bonds for options. So first, we have the put-call parity. Note that the put-call parity can also be used to determine the price bounds for the put options as well as the call options. But note that the put-call parity holds only for the European options. For American options, things are different. For the American options, because we know that the American call option has the same price as the European call option, so instead of the inequality, we have that the American call option price plus the cash K times E2 minus RT is always smaller or equal than P plus S, the stop price plus the price of the put option. We also have the inequality. With the other side. So it says that the call option price plus the cash K is greater than the put option price plus the stop price. So we can use contradiction to prove, assume that the left hand side is smaller or equal than the right hand side. Then we can buy the left hand side and sell the right hand side to arbitrage. This is how we prove this inequality. For American call options on non-dividend paying stock, it is never optimal to exercise early. To exercise before maturity is not the optimal strategy. Instead, we can sell the option instead. It is only optimal to exercise the call option at maturity. So for the dividend paying stock, it is only optimal of the American call options to exercise in the end or right before dividend is paying, because the stock price will drop after dividend paying date. So for the dividends, we will need to discount the dividend to its current value for valuation of the dividend and calculate the price bounds for the call options. As always, we need to discount the dividend to its current value with the risk-free interest rate. So for the European call options and European put options, things are simpler because they have the fixed maturity date at which the options can be exercised, and before that date the options cannot be exercised. On the other hand, for the American put option, it can be optimal to early exercise the put option. It is because the expected price is larger than the present price given a positive interest rate. So if one believes that the price drops to a very low level, then the investor could exercise the put option instead of selling it. Because if the interest rate is positive, then the expected price in the future is always greater than the current price. The theoretical price is always greater than its European counterpart for the American put option because it can be optimal to early exercise the put option. So since the American put option gives more freedom than the European put option, so its price is always higher than the European put option with the same strike price and at the same maturity date. So these two conditions are important, the strike price and the same maturity date. So next, with the options, a natural question to ask is whether we can arbitrage. We should always keep in mind how we develop the arbitrage-free argument. So if theoretical price for two assets A equals to B, but the market price FA is greater than FB, then we can sell A and buy B. This is how we arbitrage. If the market prices for two assets of the same theoretical price are different. We short sell the one with the higher market price and buy the one with the lower market price. And the difference is how much we can arbitrage. So this argument is valid if short selling the stock or the assets results in no cost, and borrowing money from the bank will lead us to pay for the interest at the risk-free interest rate. Another useful hint for us to do a qualitative study is that if something is worth non-negative in the future, which means that in the future it is either positive or zero, then the value of this asset must be non-negative right now. If the possibility that this asset is worth positive is greater than zero, then the asset, the price of the asset right now, it must be positive, because we have a positive probability to make a gain from this asset. There are different trading strategies with respect to options, and we should pay attention to it as we saw in the midterm. We have the spread, we have the straddle, the bull spread, the bear spread. We have the straddle, two options. One is a put and one is a call with the same strike price and the same date. We have strips and straps. So basically, we can use options to create or to approximate any payoff functions we wish to approximate. One thing we need to pay attention is that we must make sure to understand whether the investor is buying, selling. For each option, or doing both for each option with different strike prices and maturity dates. So this is important. Sometimes the investor is buying one option but selling the other option. Sometimes the investor is buying two options. Also, we cannot arbitrage with options. We should always keep in mind that the no arbitrage argument is important. So sometimes we may be asked to examine whether there exists an arbitrage opportunity, and if there is, then there does exist an arbitrage opportunity, then we should be able to develop the whole strategy of how to arbitrage. Thank you.